Let's go next door to Ghana, where the Monetary Policy Committee today concluded their July meetings. The governor of the bank, Dr. Johnson Asiama, was speaking a few hours ago to the considerations and the decisions to slash the country's headline rate by a whopping 300 points to 25%. Let's listen.
In line with the easing underlying inflation pressures, the bank's main core inflation measure, which excludes energy and utility items, has declined markedly. Similarly, inflation expectations by banks, consumers, and businesses are broadly anchored. Growth in monetary aggregates remained subdued during the first half of the year, primarily due to the tight monetary policy stance, strong liquidity management, and reduced government borrowing. In line with the disinflation process and easing inflation expectations, interest rates at the short end of the money market have declined sharply and in turn reduced the cost of government borrowing. Data on budget execution indicated a strong commitment to fiscal consolidation as expenditures adjusted within set targets to accommodate the revenue shortfalls during the first half of 2025. As a result, the overall fiscal deficit on commitment basis was 0.7% of GDP, outperforming the budget target of 1.8% of GDP. The deficit was largely financed from domestic sources. As at the end of June 2025, the total public debt had declined to 43.8% of GDP from 61.8% of GDP at end December 2024. And this was due to the appreciation of the cedi, lower domestic borrowing, and the external debt restructuring. In the banking sector, the financial soundness indicators reflected continued asset growth, improved solvency, liquidity, profitability, and efficiency in the first half of the year. The non-performing loan ratio eased in June 2025 on account of lower growth of non-performing loan stock relative to credit. Continued improvement in the economic conditions, ongoing recapitalization efforts from capital injections and profits, coupled with the implementation of strict credit underwriting standards, should enhance resilience in the banking sector. The external sector has improved markedly, with a record current account surplus of $3.4 billion in the first half of 2025, supported mainly by higher prices and increased production volumes, talking about gold and cocoa. The current account surplus, together with the outturns in the capital and financial accounts, culminated in an overall balance of payment surplus of $2.2 billion, significantly higher than the $588.5 million recorded in June 2024. On this score, our gross international reserves stood at $11.1 billion as at the end of June 2025, which is equivalent to 4.8 months of imports of goods and services, compared to $8.9 billion or 4 months of imports cover as at end December 2024. The external sector outlook is positive, and this is anchored on favorable commodity prices and improved remittance inflows, despite the resumption of external debt service. On the back of the strong external sector performance and increased reserve accumulation, the cedi has further strengthened against the major trading currencies. And in the year to 25th July 2025, The cedi appreciated by 40.7% against the US dollar, 31.2% against the British pound, and 24.2% against the euro. Overall, the committee noted that macroeconomic conditions have significantly improved, inflation expectations are broadly anchored, external buffers have strengthened, and confidence in the economy is returning. The July forecast also shows that headline inflation is expected to decline further in the third quarter of 2025 and trend within the medium-term target of 8 plus or minus 2% by the end of 2025, earlier than initial projections. However, there are upside risks to the inflation outlook, which include potential supply chain challenges emanating from the global trade tensions, an upward adjustment in utility tariffs. These notwithstanding, the impact of these risks on inflation are expected to be offset by appropriately tight monetary policy stance and continued fiscal consolidation. Given these considerations, the MPC, by a majority decision, voted to lower the monetary policy rate by 300 basis points to 25.0%. And looking ahead, the committee will continue to assess incoming data and likely reduce the policy rate further should the disinflation trend continue.